This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Dow 20,000, new research puts it in sight, and there are a few sectors that may lead the market higher over the coming months. Man-made mosquitoes, can genetically engineered bugs help stop the spread of the Zika virus? Lousy 401k, why more employees are suing their employers over their retirement plan offerings. Those stories and much more tonight on Nightly Business Report for Wednesday, August 10th. Good evening, everyone, and welcome. I'm Sue Herrera. Tyler Matheson is off tonight. Get ready for Dow 20,000. Yes, you heard me right. It may sound like a world away, especially since the broader market has been making very small moves over the past few weeks. But new research shows it's not. According to S&P, a compilation of one-year target prices for the 30 members of the Dow puts that blue chip index at 20,000 in just 12 months. That's roughly 8% higher from current levels. Now, S&P does say that this is based on analyst targets, which tend to be optimistic. But there is some consensus on which sectors will outperform over the next few months and help take the market higher. Dominic has that part of the story.
If you haven't looked at your 401k or retirement account statements in a while, you might be in for a pleasant surprise, even if it's just a little one. That's because there doesn't seem to be anything that can take this stock market down, and we're near record highs for all the major U.S. indices. For some experts, the outlook for the rest of the year is somewhat promising.
We're looking for earnings getting at least less bad, and I think we'll turn to the positive here by the end of the year. And you still have what we would argue is lower for longer in terms of interest rates. And whichever way you cut it, lower interest rates do mean higher prices in the long run for assets, and those assets include stocks.
But that doesn't mean that the entire market is just going to start soaring higher. There's a debate as to what parts of the market will lead the way and which parts fall behind. Many strategists believe the sectors like technology and healthcare will help drive things higher.
I actually like healthcare in particular because I think you have, frankly, stronger growth. And frankly, you're also tethered to longer-term secular trends, such as the aging, the demographic dynamics in the U.S., the aging of the boomers. In technology, I think it was reassuring to see a lot of the sort of value tech, big mega cap names performing fairly well through the most recent earnings season.
That might provide some fuel for an overall market move to the upside. Technology and healthcare are two of the biggest parts of the S&P 500, and they've had a good amount of success in reporting better than expected earnings so far this season. As for where there's less optimism, well, there are certain places out there.
I think there are areas of utilities you need to be more concerned about that, frankly, have very high valuations. There are areas of telecom, particularly in some of the carriers, where you've got pricing competition. And then there's, frankly, areas of consumer staples that have long-term secular concerns related to health and wellness and so forth that I'd also be cautious at these valuations.
As investors weigh future events like our presidential election and whether the Federal Reserve will do anything with interest rates, how they weigh different parts of the market could go a long way towards better or worse returns heading into 2017. For Nightly Business Report, I'm Dominic.
On Wall Street, oil prices dropped, so did energy stocks, and the broader market fell along with them. By the close, the Dow Jones Industrial Average was down 37 points to 18,495. The Nasdaq was off 20. The S&P 500 declined 6. And joining us now to talk more about the markets is Rich Bernstein, Chief Investment Officer at Bernstein Advisors. Good to see you again, Rich. Welcome back.
Hi, Sue. Thank you. How are you?
I'm good, thank you. Let's start with how you view this market. I mean, we posed the question Dow 20,000, and I know there were some who disagreed with you wrongly when you were more optimistic on the market than others. So how do you feel about it now?
Sue, you know, you're right. We have been pretty consistently bullish for the past 6-7 years. We've thought for some time that this bull market would be one of the biggest ones of maybe my career. I think it's already the second longest in the post-war period. And I think by the time we're done, it will be one for the record books. I think this bull has good legs to run on still. And I think if you just want one reason why, it would be because nobody wants to play.
Right.
The fear that is still out there, I haven't seen anything like that 7 years into a bull market in my entire career.
Yet if you're a money manager and you have to put money to work, really equities is one of the only places that you can go right now.
Well, I wouldn't necessarily say just equities. I mean, we have in our portfolio some exposure to gold. We have some exposure to lower quality bonds. And I think there's a lot of things that you can look at. The common thread, though, in our portfolios is that one should expect continued improvement in the economy and improvement in corporate profits. Now, I didn't say the economy would be good in an absolute sense. The market doesn't really care about that. Markets care more about better or worse, not about the absolutes of good or bad. So our feeling is, and our forecast and what we're seeing in corporate profits is that they will continue to improve for the next 12 to 18 months. If we're right on that, then I think the bull market continues.
What about valuations? There are a number of people on the street who think that stocks are overvalued, but you think that they're maybe fairly valued.
Correct. And the reason why is that, people see the price earnings ratio of the S&P 500 and they see it, depending on how you measure it these days and what definition of earnings you're going to use, it'll be somewhere between 20 and 25. The absolute number doesn't really matter, but in general, people will say that the market is expensive because you've got this very high price earnings ratio. I think what people are missing is what is that price earnings ratio relative to the level of interest rates? For example, if we go back to 1999, I'm sure a period most of your investors, most of your watchers remember, the PE ratio on the S&P was very high 20s, if not 30s, but the 10-year T-note at that time was 6.5%. Today, we have a PE ratio, as I said, somewhere between 20 and 25, and a 10-year note of 1.5%. It's very hard to argue that with a 1.5% 10-year T-note, that stocks are dramatically overvalued. Right. I think that's very difficult in this environment to make that argument.
All right, Rich, we have to leave it there. Thanks so much. Good to see you again.
Thanks for inviting me on, Sue.
Rich Bernstein with Bernstein Advisors. There's a new report on the job market, and it shows a kind of mixed picture. The rate of layoffs fell about 1% in June. That matched the lowest on record dating back 15 years. But the Labor Department's monthly survey of labor market turnover also showed that the pace of hiring into new jobs has yet to fully recover from the 2009 decline. And since switching jobs is one of the ways that workers get raises, the report may explain why wage gains have been muted. To politics now, where a new batch of emails reportedly show top Clinton Foundation officials sought access to the State Department while Clinton was secretary. The documents were released by a conservative watchdog group. Clinton has always denied charges that the charitable foundation worked to reward donors with access to the State Department. John Harwood joins us now from Washington and has more. John, how damaging are these emails likely to be?
Well, Hillary Clinton has a problem with people believing she's not trustworthy. That's dogged her campaign. Majorities of people say that. Donald Trump calls her Crooked Hillary. So this plays into that storyline with the idea of a conflict of interest. It's more smoke than fire. There's no allegation of specific things being done to benefit the donors. One of the emails that came out today was a Clinton Foundation official asking the State Department to put a wealthy donor in touch with a person on Lebanon. That person at the State Department said he never met the wealthy donor, so don't know whether anything came of that. However, the appearance of conflict of interest is not helpful to Clinton, and Donald Trump was ripping her for it today.
Now, meantime, Ms. Clinton responded to Donald Trump's Second Amendment comment that have been interpreted by some as inciting violence. Take a listen.
His casual cruelty to a Gold Star family, his casual suggestion that more countries should have nuclear weapons, and now his casual inciting of violence. Every single one of these incidents shows us that Donald Trump simply does not have the temperament to be President and Commander-in-Chief of the United States.
So, John, what's the fallout been, and will there be more?
Well, Donald Trump extended the conversation about that today by disputing a report by CNN that the Secret Service had conversations with his campaign. He said that that wasn't true. He didn't address it directly in his remarks. He did say that the press has a pattern of taking stories that aren't really stories and making a big deal out of them. That seemed to be an allusion to what happened the day before. He did say that the Second Amendment was under siege, and he urged people to rally in support of it. But the question is going to be how much do other Republicans who are concerned about his comments, how much do they distance themselves? Paul Ryan said last night he needs to clear this up quickly. He hasn't done it publicly in any detail yet.
All right, we will wait and see, John. Thank you very much. John Harwood in Washington. Still ahead, the fight against Zika. Can man-made mosquitoes wipe out the ones carrying the virus? Heavy discounting and declining foot traffic in malls impacted both Ralph Lauren and Michael Kors. But Ralph Lauren's quarterly results came in largely as expected, and the company is spending a lot of money to turn itself around. It's also cutting costs, and investors liked that, sending the shares up more than 8%. But over at Michael Kors, a stronger dollar and fewer shoppers at the malls led the luxury goods maker to report a bigger than expected drop in quarterly comparable store sales. The retailer also gave a cautious forecast, and shares fell more than 2.5%. Michael Kors is just one of a handful of luxury handbag makers that are fed up with department stores and the constant discounting, and it has a strategy to battle back. Courtney Reagan has that part of the story.
High-end handbag makers aren't happy with department stores. As shopper traffic continues to languish, department stores keep upping the ante on the discounts, just as brands like Michael Kors, Coach, and Kate Spade are working hard to go the other way. These handbag makers are working on rebuilding their premium brand images by returning to premium pricing. Michael Kors is most exposed of the three, with half of its sales coming from the wholesale channel, and it's looking to remove itself from all of its retail partners' couponing, including friends and family sales held at department stores like Macy's.
We think it's creating confusion in the consumer's mind relative to the value of the Michael Kors brand when it's being seen so often on sale in so many different places.
Earlier this summer, Michael Kors confirmed it was pulling back on the number of products it sends to department stores, explaining less available product should lead to increased demand, and that demand will be at full price versus sale. Coach is taking it a step further, pulling its product out of a quarter of its North American department store partners. The brand says not only is volume below the threshold at these locations, but the increasing promotional levels at department stores are creating a negative impact on long-term brand health.
We think preserving the brand in that aspirational luxury type of positioning is the right thing to do. It seems like a reliance on the wholesale at large is becoming less, and the retail mix shift is something to talk about.
It's a conversation analysts and investors are certainly having, trying to determine what it means for continually challenged department stores as well. For Nightly Business Report, I'm Courtney Reagan.
Disney took a giant step into the future. As we reported last night, the world's largest entertainment company is making a $1 billion investment in a streaming media company created by Major League Baseball. But this deal is about a lot more than just streaming sports. As Julia Borston reports, it's about reshaping an industry that touches and entertains us all.
Disney's making a $1 billion bet that the future is digital, buying a third of streaming video company BAMTech. And Disney's collaborating with BAMTech to create a streaming ESPN-branded sports app with content like hockey and baseball. It won't stream existing ESPN channels, but Disney CEO Bob Iger says this opens the door to overhauling ESPN's business down the line.
If the business model that is supporting these great media properties starts to fray in any significant way, we have the ability to pivot quickly and put out a direct-to-consumer product that could potentially either replace it or supplant it. And that's really important. We're not suggesting that it's going to happen. It's our hope that that doesn't happen, but this certainly puts us in a great position should it happen.
Apart from ESPN, Iger says this investment will help Disney bring brands across the company direct to consumers with new streaming options. Imagine a Disney app for kids or even a subscription service focused on Marvel content. And it's not just a la carte content. There are new lower-cost streaming bundles in the works from DirecTV and Hulu. Disney says its top channels will be included in both of them.
I think this move into direct streaming technology for the company is a recognition that there is a future where the cable set-top box is no longer the nexus with the consumer.
The question investors are evaluating now is whether the consumer shift to streaming and away from traditional TV is going to eat into current Disney revenue streams.
For Disney specifically, they've had this amazing deal, particularly on ESPN, where 80 million people are paying for ESPN whether they want it or not. And as we go to various cord cutting and unbundling situations, they're going to have to reset the business model.
With cord cutting on the rise, consumers may not be as interested in paying for a traditional TV bundle. So Disney and the other media giants are working to make sure they're wherever consumers want to be. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Perrigo slashes its full-year outlook, and that is where we begin tonight's market focus. The pharmaceutical company said increased competition and lower prescription drug prices prompted it to lower its earnings forecast. The company also reported worse than expected profit in the latest quarter. The shares fell more than 9.5% to $86. Orbital ATK said it will delay filing financial results for the quarter due to accounting errors tied to a military contract. The aerospace contractor said it plans to restate more than a year's worth of its results. In addition, the company reaffirmed its earnings outlook for this year. Shares plummeted 20% to $70.79. Sales growth disappointed at Wendy's. The fast food chain reported an uptick in same-store sales, but it was significantly lower than what analysts were looking for. The company also said revenue and profit for the quarter fell as more consumers opted to dine out less. Shares down 28 cents to $9.91. Shake Shack raises its full-year forecast. The burger chain saw both profit and revenue rise, with results surpassing analysts' estimates. But the company only saw same-store sales grow 4.5%, and analysts were anticipating a 5% increase. That sent shares sharply lower in initial after-hours trading. The stock finished the regular session down 1% to $40.99. Well, this may sound like something out of a sci-fi movie, but it is very real. The FDA recently gave the okay to deploy armies of genetically engineered mosquitoes to fight the spread of the Zika virus. And as Meg Terrell reports, the plan may soon be tested in a Florida community.
Though we've been battling the mosquito that carries the Zika virus for decades, public health experts say our current methods don't always work well enough. That's what happened in the area of Wynwood, Miami, where there have now been 21 cases of Zika acquired from local mosquitoes. But in another area of Florida, health officials have been considering a new method of mosquito control, a genetically modified bug programmed to wipe out its own kind.
The usual methods of reducing this particular mosquito really don't work.
Here's how the technology works. Intrexon subsidiary Oxitec modifies male mosquitoes to be released and mate in the wild. The offspring they produce can't survive. If enough of these bugs are released, they'll outperform their wild brethren, ultimately wiping out much of the population. In field tests in Brazil and elsewhere, the Oxitec mosquitoes have reduced numbers of the bugs, known as Aedes aegypti, by more than 90%. Intrexon's Kirk sees it as potential big business. The market for pesticides to control disease-carrying bugs is estimated at $2 to $3 billion annually.
I think it's actually significantly more than that. And the reason is, it should be borne in mind that the footprint of this mosquito on a worldwide basis is absolutely enormous now. It's basically everywhere between 35 degrees north and south latitude and below about 2,000 meters in altitude. Just an absolutely enormous footprint. It's the largest footprint that this mosquito has ever occupied.
The approach just received clearance from the Food and Drug Administration to start testing in the U.S. The regulator found no significant environmental impact as a result of the GMO mosquitoes. But the idea has faced local opposition in the Florida Keys, where Intrexon aims to do the first U.S. trial. The community of Key Haven will vote in November on whether to do the test, when residents cast their ballots in the general election. Vote for president and whether to test GMO mosquitoes. Intrexon's Oxitec says it's having conversations with different areas of Florida, also considering whether to test the technology. Meanwhile, the hard work continues of trying to keep the bugs at bay.
we have the capacity to do it, but it's going to take a sustained effort, probably over multiple years. You're not going to completely suppress this mosquito population in one season, but we know how to do this.
Communities like the Florida Keys are using traditional methods, climbing through backyards, hunting mosquitoes, and spraying pesticides by air, as well as tireless vigilance to try to keep residents safe. For Nightly Business Report, I'm Meg Terrell.
Coming up, meet the retiree who is in the middle of a prolonged legal battle with his former employer over his retirement savings. A legal win for Twitter. A judge today dismissed a lawsuit that accused Twitter of supporting Islamic State rhetoric. The case was brought by the widow of an American killed in Jordan. She claimed the social media company gave the terror group a voice. The judge ruled that Twitter cannot be held liable, but gave the plaintiff a chance to refile an amended lawsuit. A growing number of employees have sued their employers over their 401k plans. Most of the lawsuits center around a similar complaint: excessive fees. The rise in the number of lawsuits follows a Supreme Court ruling last year that basically increased the responsibilities of those who oversee company retirement plans. Just last night, we told you that 3 renowned universities were being sued. Tonight, Sharon Epperson tells you of one man's legal battle with his former employer.
Former engineer Ronald Tussey is spending his retirement much like he imagined he would. What he didn't plan on was a prolonged legal battle with his former employer, ABB, over his 401k plan.
It was very difficult to figure out exactly what it was costing you.
Tussey eventually filed a class action lawsuit claiming the company failed to comply with federal law, causing plan participants to incur unnecessary and improper fees.
We spent a year and 9 months looking into industry practices and the ABB plan, and I came away convinced that people were being ripped off for their retirement assets.
A Missouri federal court ruled in favor of Tussey, ordering ABB to pay $37 million to its employees and retirees. But no one has received a penny. Since the case is still on appeal, ABB said it could not comment on an open case, but did tell us that, quote, benefit offerings are reviewed regularly to ensure they remain competitive and compliant, as well as cost-effective. Experts who help companies design 401k plans say that companies need to do a better job understanding how fees work and be able to explain to participants where the money's going.
Plan sponsors really need to be educated on, well, then who's getting paid and how are they getting paid?
Along with a rise in 401k lawsuits over the past several years, 401k fees have been declining, with the average total cost dropping to less than 9/10 of a participant's assets. But Ronald Tussey says many companies still need to do more.
It should be simple. It should be straightforward what the cost is to have a particular fund.
For Nightly Business Report, I'm Sharon Epperson.
According to a new report from the Federal Reserve Bank of New York, some of the nation's lowest scoring borrowers are getting credit cards again. New issuance of cards for those with credit scores under 660 has been rapidly expanding since 2009, approaching pre-crisis levels. Craig Dismuke, chief economist at Vining Sparks, joins us now to talk more about that. I would think this is a worrisome sign, Craig, but you disagree a little bit.
Well, I think there are a couple of things to remember. First of all, generally the expansion of credit is positive. When you have expansion of credit, it increases consumers' ability to spend. It shows that lenders are willing to lend again. And it also shows that consumers have enough confidence to be willing to take on more credit. So it's not always a bad sign. When you get too hot and you see too much growth, that's when you have to worry about it. But when I think you step back and look at the big picture, the amount of credit that's outstanding right now is still much lower than it was prior to the crisis. And so when you look at it from that level, I still think we're at very manageable levels.
What about, there are those out there who say that, well, the reason that they're using credit again is they're trying to make ends meet because they're either working 2 jobs and wages haven't grown significantly for some time now. So what do you make of that argument?
So that's the one downside, is that for the consumers who are using credit to make ends meet, And you're right, wages haven't been growing, and the labor market is getting better, but there's still some areas of weakness. That's where you have a concern. And so we have to wait and see how that plays out. But the thing that the trend that we still see playing out right now is that delinquencies on credit cards are still coming down. So it's still positive. It looks like the sector is still positive. And we may be seeing the very beginning of an increase in credit that could be problematic later on. But for now, I'm not that worried about it. I don't think it's excessive at this point.
The cynical part of me says that the lenders are extending credit because they can't make money in other ways on other instruments because interest rates are so low. And with credit cards, they can charge a much higher interest rate. And so that's one of the reasons they're expanding credit. What do you think?
Yeah, I agree with that. And it's one of the outworkings of Fed policy. With the Fed keeping rates as low as they have for so long, and now you've got other central banks that are helping do the same thing. It really is making it very difficult for these lending institutions, and so they're looking for any kind of loan they can make. And there's not much demand on the real estate side, and so they're going into car loans, which has been, auto lenders have been having a party for 6 years, and now it's with credit cards. We're starting to see expansion there as well.
All right, Craig, thank you. I hope you're right. Craig Dismuke with Vining Sparks. And finally tonight, San Jose, California became the first U.S. city where the price of a typical home costs more than $1 million. San Francisco came in second, where the median price is more than $885,000, and Anaheim, California, third at $740,000. And that does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening. We'll see you tomorrow.